Welcome to the Deep Dive. Today we're doing something a little different, really digging into just one specific day in the financial markets. We've got a whole stack of news, data, reports you shared with us, all focused on this single snapshot.
That's right. It's like freezing a moment in time. And our goal really is to cut through the noise. We want to unpack the key moves, figure out the why behind them, and give you the essential takeaways without getting totally bogged down in, every single data point.
Okay, sounds good. So let's jump right in. The big headline, the main story from the sources.
Yeah.
Seems pretty clear. U.S. stocks were down.
They were, yeah. A definite negative tilt for the major U.S. indices today. The S&P 500, for instance, it finished down about 0.5%, closed just under that 5,900 mark, around 5,889, give or take.
Okay. And the Dow, the NASDAQ, similar picture.
Very similar. The Dow Jones also slipped roughly 0.6%, finishing near 42,100. And the NASDAQ composite, lots of tech in there. It saw basically the same kind of decline, also down about 0.5%, landed near 19,100.
Interesting. And I noticed the small cap 2000 index. That one fell even more, like 1%.
It did, yeah, down about 1.01%. That often happens. Smaller companies can sometimes be, more sensitive to shifts in sentiment or economic worries. They got hit a bit harder today.
Right. And something else that caught my eye, the VIX was up almost 2%. That's the volatility index, the quote-unquote fear gauge, isn't it?
Exactly. The S&P 500 VIX.
So stocks down, VIX up. What does that combination typically signal? Just briefly.
Well, it's that classic inverse relationship, really. When the VIX climbs, it means traders are expecting more choppiness, more price swings ahead. So seeing it rise while the main indices are falling, it generally points to increased investor anxiety or uncertainty kicking in. It fits the narrative of a market reacting to some kind of negative news or worry.
Okay, so let's unpack those worries then.
Yeah.
What did the sources say was actually driving the market down today? What were the reasons cited?
The sources really highlighted two main things. First, increased tension around U.S.-China trade. Specifically reports that President Trump had ordered U.S. chip software makers to stop selling to China. That kind of news, especially in a critical sector like semiconductors, tends to make investors pretty nervous about, supply chains, global growth, company profits.
Right. Trade angst focused on tech. Makes sense. And the second factor.
The second one was related to the Federal Reserve. The minutes from their May meeting came out, and according to the sources, those minutes specifically mention, quote, tariff-related uncertainty.
Okay. So the Fed itself is acknowledging that these trade issues, these tariffs, are creating uncertainty that they're watching.
Precisely. It connects directly to the trade news. You've got the headline trigger, and then you've got confirmation that the central bank sees this kind of thing as a potential risk for the economy.
So it's not just the news, but the Fed sort of validating the concern.
Yeah.
That adds weight.
Exactly. The sources position those two things, the specific trade reports and the Fed's noted uncertainty, as the key reasons for the downward pressure on U.S. stocks today.
Okay, so that explains the U.S. picture. But was this purely a U.S. story, or did we see similar reactions elsewhere, maybe in global markets or other assets?
That's a really important question. Looking at the international index data provided, it wasn't just the U.S. We saw indices like the DAX in Germany, the broader MSCI World Index. They were also down, 0.5% or more.
So some spillover.
Definitely some spillover, but it wasn't perfectly uniform. The sources showed indices in Canada, the S&P TSX, and Mexico's IPC were actually slightly up, or basically flat. So a bit of a mixed picture globally, but the negative sentiment in the U.S. was certainly felt in other major markets, not totally isolated.
Got it. And what about other corners of the market, like commodities, oil, gold?
Commodities were really all over the place. Quite interesting, actually. Crude oil, the U.S. benchmark WTI, was up today, gained over 1%.
Huh. Oil up when stocks are down.
Yeah. But then gold and silver, which you sometimes think of as like safe havens, they were actually down a bit today. Gold off about 0.25%, silver maybe 0.2%.
Okay.
And then natural gas took a big hit, down over 5%. So it really shows different markets marching to their own beat sometimes. Equity markets worried about trade and the Fed, but commodities reacting to maybe supply issues, weather, other factors.
A real mix there.
Yeah.
And bonds. I saw yields were moving.
Yes, and this is key. U.S. Treasury yields were generally up across the board. From the short-term 3-month bills all the way out to the 30-year bond, yields rose. The The 10-year yield, which is watched super closely, was up almost a full percent itself, around 0.92%.
And rising yields mean falling bond prices usually.
Generally, yes, they move inversely. Rising yields can signal a few things, maybe changing expectations about future interest rates, maybe worries about inflation, or sometimes just shifting money flows within the market. On a day like today, it's likely tied into that broader uncertainty mix.
Okay. And even crypto wasn't immune.
Nope. The major cryptocurrencies listed, like Bitcoin and Ethereum, they were also in the red today. Bitcoin down over 2%, Ethereum down almost 2%. So that risk-off feeling, that selling pressure, it definitely extended into the crypto space as well.
Okay, here's where it gets really interesting for me, zooming in from those big averages. The sources listed individual stocks.
Yeah.
Any big familiar names stand out in the movements?
Oh, absolutely. Even on a down day for the market overall, you always see individual stories playing out. Looking at some well-known ones, Tesla, TSLA, that was down today, about 1.6%.
Okay.
NVIDIA, the chip giant,
Yeah.
NVDA, also down slightly, roughly 0.5%, mirroring the NASDAQ. Alphabet, Google's parent, saw a small dip too.
But not everyone was down. I thought I saw some green.
You did. Definitely not everyone followed the trend. Apple AAPL was actually slightly up, just barely, 0.13%, but still positive. Meta Platforms, Facebook's parent, also managed to gain.
And looking at those market movers lists.
Yeah.
Some really big swings there, right?
Huge swings. You had FICO, the credit score company, surging, what was it, over 7.5%, a massive gain. But then on the other side, you had Cadence Design Systems, CDNS, a software firm, dropping sharply, down over 10%.
Wow. That really underscores the point, doesn't it? Even when the headline is negative, there's so much happening under the surface for individual companies.
It absolutely does. I mean, these individual stock moves are influenced by the overall mood, for sure, but they're also driven by company-specific news, earnings, sector trends, things the sources don't necessarily detail here, but they're clearly at play.
Okay, let's shift gears slightly. The sources also had an economic calendar section. Why is that important? Why track upcoming data?
Well, the economic calendar is basically the market's schedule of potentially important events. It lists releases like jobs numbers, inflation data, manufacturing reports, central bank meetings, things that give clues about the health of the economy. Investors watch these really closely because a surprise in the data, good or bad, can definitely shift market sentiment and trigger trading. It's about knowing what potential bumps or boosts are on the road ahead.
And the sources showed both upcoming stuff and things that just happened.
Exactly. You see things listed for the near future, like the weekly U.S. crude oil inventory numbers from API or international data like Australian capital expenditure figures, stuff analysts are waiting for. And then it also lists recently released data. And crucially, that included those FOMC meeting minutes we already talked about, which clearly did move the market today. Plus other things like results from a U.S. 5-year Treasury note auction.
Got it. Okay, and finally there was a section on analysis and opinion. What kinds of discussions were happening around this particular market day based on the sources?
It looked like analysts were trying to make sense of these cross-currents we've been discussing. There was analysis on broader trends, like in commodities. There were pieces focusing on specific company situations, maybe potential recalls impacting Ford, or big strategic moves like GameStop reportedly getting into Bitcoin.
Interesting.
And you also saw commentary dissecting what big-name investors like Michael Burry might be doing or thinking based on their filings or comments, trying to read the tea leaves from the influential players.
And I saw mention of Popix AI. What's that about?
Yeah, that points to another layer of analysis. It suggests there are algorithmic, AI-driven strategies being used to pick stocks based on quantitative factors. So you have human analysts offering opinions, and alongside that, you have these data-driven, automated approaches trying to find opportunities in the market data. It's part of the modern market landscape.
Okay, so let's try to bring it all together then. We've unpacked the numbers, the drivers, the different asset movements. What does this kind of deep dive into one day's financial snapshot really mean for you, our listener? What's the takeaway?
I think the key takeaway is seeing how interconnected everything is. When you see the market react like it did today to specific news about U.S.-China trade or to the nuances in the Fed's language about tariffs, it really highlights how these big geopolitical and policy issues have very real, very immediate consequences in the financial world. It's not abstract.
Right, it shows those headlines we read can directly translate into market movements.
Exactly. And understanding why the market moved because of trade fears, because of Fed uncertainty, helps you appreciate the larger economic forces that are always swirling around. These are forces that can ultimately influence jobs, the prices you pay, investment opportunities, the whole economic environment.
And the fact that individual stocks showed such different results.
Yeah, that's crucial too. It reminds you that the market isn't just one single thing. Even on a day where the main averages are down, there are companies thriving, companies struggling, specific sector stories unfolding. There's always complexity beneath the surface number.
So maybe a final thought to leave our listeners with, based on today's dive?
Yeah.
Something to chew on.
Okay. Well, thinking about how strongly the market reacted to that trade headline and the Fed minutes, it raises a really interesting question, I think. How much of today's movement was a truly fundamental reaction, investors recalculating the actual economic outlook based on this news, versus how much was maybe more of a short-term, perhaps even somewhat emotional response to the headlines themselves?
Ah, the perennial question. Fundamentals versus sentiment.
Right. That push and pull is always there. How much is real change? How much is just noise or immediate reaction? It's something worth considering whenever you see these kinds of market swings tied to specific events. Food for thought.
That is definitely good food for thought. Okay, so quick recap. Major U.S. indices down today, driven largely by fresh U.S.-China trade concerns, particularly around tech, and the Fed explicitly noting tariff uncertainty in its minutes. But we also saw a really mixed picture elsewhere. Oil up, gold down, bond yields rising, crypto down, and lots of variation among individual stocks. A complex day.
A very complex day indeed. Lots happening under the hood.
Well, hopefully this deep dive helped make sense of at least some of that complexity from this particular financial snapshot. Thanks so much for walking us through it.
My pleasure. Always fascinating to dig into the details.
And thanks to all of you for joining us today. We really appreciate you tuning in. Let us know what you thought in the comments below. And if you haven't already, please consider subscribing to the channel, give this video a like if you found it helpful, and definitely hit that notification bell so you don't miss our next deep dive. We'll see you next time.